session tonight. Now, what I've done, if somebody has asked a question as they registered for the webinar, I've tried to include that throughout the presentation where possible. And those, I've left a couple to the end because they didn't really fit into the end of financial year presentation. Just firstly, you need to understand that tonight's information is of a general nature only. It doesn't take into account your personal financial situation and needs, and you need to obtain professional financial advice before you make any decisions. If you do want specific advice, then we can provide that to you. We generally use this process where we have you prepare a questionnaire. We then meet with you for an initial consultation where we understand your goals, what you're trying to achieve, and then we discuss the pros and cons of a range of options to achieve those goals. That's still general advice, but if you want to go to the next stage where we provide you specific recommendations, then we provide that in writing and present that to you at another meeting. We can help you implement it and provide ongoing advice. So you can take this process as far along as you need to or wish to. Now, the first tip, as Peter had referred to, is the government co-contribution. Now, it has been scaled back over the last couple of years from if you put $1,000 into your super fund, then the government would match it with $1,500. Then it was reduced from a $1,500 co-contribution to $1,000, and now it's sitting at $500. So it's not as generous as it was before, but it is still well worthwhile doing, because if you do it year on year and you're eligible for it, then it's definitely well worthwhile doing. So if you put in $1,000 into your super fund, now this is what they call non-concessional contributions. So you just need to be aware that it's not salary sacrifice, it's not foregoing your income to put the money into superannuation. It's money that you have in your bank account that you put into your super fund as a personal or member contribution. They call it a non-concessional contribution officially, and it doesn't attract any contributions tax going into the fund, but then if you satisfy the criteria, then the government will boost your super account by $500. So what are the criteria? The first one is your total income needs to be less than $46,920. It was previously $61,920, so it's gone down this financial year. The other rule is that your income needs to be, your total income needs to be, or more than 10% of it needs to be derived from employment, running a business, or a combination of both. So you can't just be generating investment income and take advantage of the government co-contribution. You need to be actually earning some money, at least 10% of your money coming from employment, running a business, or a combination of both. You need to be less than 71 years of age, and you can't hold a temporary resident visa at the time. And one important point is that you need to lodge your tax return, your income tax return. Now, there was an interesting question that Shirley had, which was, can I claim the super co-contribution if my income is less than $2,000 and I will only be lodging a non-lodgement return? Now, I would suggest that if 10% of your total income is coming from employment purposes, so if that's your total income, $2,000, and if you're employed, your employer made some superannuation guarantee contributions, then you would need to submit your tax return, not a non-lodgement return, to actually get the government co-contribution. But you can simply do that if it's got a very simple return. Then it's a very simple process to do that either electronically or simply on a paper-based form. So that shouldn't be too difficult for you. But the key thing is that the 10% rule that you need to satisfy there, Shirley. So hopefully that answers your question about the government co-contribution. If you're self-employed and that was $2,000 and that's all the funds that you earned, or all the income that you earned for that financial year, then you would be likely to satisfy the requirement. I just have a quick question. I'll check. Peter's asking, if income is from an investment property but not a registered business, would this qualify? No, it needs to be from not investment income, but from running an actual business. So it can't be from an investment property to qualify for that, Peter. Thanks for the question. So the first tip in the financial year tip is that government co-contribution. The other thing is, if your income is between if your income is less than $31,000, well, it's $31,920, then if you put $1,000 in, the government will give you $500. If you earn between $31,920 and $46,920, then you're not going to get the full $500, and therefore you don't need to put in the $1,000. Now, I've got a calculator on my website that can work out the exact right amount for you to to contribute to get the maximum co-contribution without putting too much into the fund, or more than you need to into the fund. I'll just have a quick look at that to show you how that works. So this is the calculator. So the address is just cornerstonewealth.com.au/government co-contribution, and then it'll take you to the calculator. So if your income was $40,000, for example, and your income, just note what income includes. It includes your assessable income plus reportable fringe benefits, reportable employer superannuation, so they're any salary sacrifice contributions, any business deductions, and net investment losses. So if you're negatively gearing, then they'll be added back before your total income is calculated. So if your total income, based on this description here, is $40,000, then the optimal amount for you to put in is $462, and the government will then match it with a $231 co-contribution. Now, you can still put in $1,000, but the government is only going to give you $231. David has just asked the question, what about fringe benefits as a minister of religion? Does that add to the total income? Good question. Fringe benefits do add to it, but exempt benefits don't. So where you've got an exempt benefit account, it sort of stands separate to this, but fringe benefits do. So it's yeah, that's how I differentiate the different types of benefit from a minister's perspective. So if you're in the medical industry, you're a nurse or earning income through a hospital, for example, and can get the $9,000 of fringe benefits, they're included within this total income test. But if you're a minister of religion and you take half of your remuneration as exempt benefits, those benefits aren't included in the total income test. Thanks, David, for that question. So that's the government co-contribution. The other one that's not as well known is where there's a lower income earning spouse, and this is the eligible spouse contribution. So you can put up to $3,000 into your account, and I'll just quickly check whether there's another. Scott is saying, I think they categorise it as reportable or non-reportable fringe. So non-reportable fringe is not included in the income test. Yeah, so I'm saying non-reportable fringe benefits, I call them exempt benefits. Yeah, that's exactly right. Thanks, Scott. So getting back to eligible spouse contribution, you can put up to $3,000 into your spouse's superannuation account, so $3,000, and you can get a $540 tax offset. So an offset is money that you get back. It's not a deduction. You actually get the money back. So any tax that you've paid, you can get that $540 back. So the criteria is that your spouse, if they earn less than $10,800, then, and you put $3,000 into their account, their superannuation account, as a spouse contribution. Now, you have to define it as a spouse contribution and then also specify on your tax that that's what you've done. And then you'll get this $540 back. If your spouse earns over $10,800 but below $13,800, then it scales back similar to the government co-contribution when it's between $32,000 and $47,000. So well worth doing. So you're effectively getting $3,000 into your super fund, and it's only costing you, $2,460. So if you add those two together, it's $1,000 that you're saving there. Obviously, it doesn't apply to everybody, but well worth considering. Right. So that's the government. So that's the eligible spouse contribution. Now, another one is a super-related one. Is that you can make what we call personal deductible super contributions. Now, these are what we call concessional contributions. Concessional contributions are like your employer contributions, your 9.9% that your employer puts into your super for you. Your salary sacrifice contributions that you're putting in, that you can put into your super in addition to what your employer puts in. And it also includes personal deductible super contributions. These are contributions of, say, you might have lump sums of a $10,000 amount that you can put into your super. You then claim it as a deduction. The super fund will deduct 15% tax from that, but you can reduce your personal income tax by that $10,000. Now, you're only eligible for this if you satisfy the 10% test. Now, the 10% test is the opposite to the government co-contribution. Now, so you need to, this 10% rule that you need to satisfy is less than 10% of your total assessable income needs to come from employment purposes or reportable fringe benefits, for example. And the beauty of this one is that you can just reduce the amount of tax that you pay, similar to salary sacrificing to super, but you can put in more lump sum. So if you're eligible, you could actually put in the lump sum now before the end of the financial year and reduce the amount of tax that you pay. But the important thing is that you need to be eligible. If you're an employed person, you're very unlikely to satisfy this 10% test. But if you have sold a significant asset and only working part-time or not working at all, then you potentially could make these deductible contributions to offset your tax. Now, somebody asked a question in relation to salary sacrifice, so I just thought I'd explain how this 10% rule works. How the 10% rule works is that if you've got employment income of $10,000, and that would mean that you would need to have non-employment income, so investment income, of $90,000 to satisfy the 10% test. So 10% of your total income coming from employment purposes. Now, another way to look at it is the other way. So if your total income was $50,000, to satisfy the 10% rule and make these contributions, less than $5,000 of it can come from employment purposes. So hopefully you appreciate how that 10% rule works, and then how you work out whether you're eligible to make these deductible type contributions. So Kim asked the question, if you're in your mid-50s, how much should I be putting in extra as a contribution prior to the end of the tax year when only working a 3-day week? Well, the first question is, are you substantially self-employed? That is, you satisfy the 10% rule like on the previous page. And if you're working 3 days a week, you're potentially not. And therefore, the only way that you can make these type of contributions to super is through salary sacrifice and reduce your tax, reduce your income that way. Now, if your only option is to do it through salary sacrifice, then you're basically limited to whatever salary you've got left for the rest of the financial year. So if you've got no pays due in the rest of the month, then you can't actually salary sacrifice anything else. But if you've got one pay left, you could potentially salary sacrifice all of that pay. But basically, you're limited to whatever pay you've got remaining for the rest of the financial year. Now, if you are substantially self-employed, you can make these, what we call those deductible contributions, and you can claim a larger amount, up to the contribution limit, which this year is $25,000 per annum. Now, just to clarify, I guess, the next financial year, if you are going to salary sacrifice, answering Kim's question about how much should I salary sacrifice, it really depends on your income. Ideally, we would reduce our income so that we're not paying tax at more than 15%. And if you look at the tax-free threshold, this is for the 2012-13 financial year, it's just cut off a bit there. The tax-free threshold is $18,000, so you don't pay any tax at if you earn less than $18,20. But if you include the low income tax offset, it actually is effectively $20,500. Or if you're 55 and you get the mature age tax offset as well, then it's just over $23,000 you can earn without paying any tax. So let's have a look at an example. If we've got someone earning $44,000 and they're 55 years of age, they could potentially reduce their taxable income to $23,000 by salary sacrificing $21,000 over to their super fund. And then their taxable income would reduce from $44,000 to $23,000, and I think it's around $2,275 in tax that they would be able to save. But as I mentioned earlier on the previous slide, that if you've only got one pay packet or no pay packets left for the rest of the financial year, then you can't really do much about it if you're a salaried employee. I just have a question from Keith. Currently, my shirt salary payslip uses the term fringe benefit, not exempt benefit. Can you clarify the definition of both terms? Yeah. I think the term that Scott used previously, Keith, getting back to the difference between fringe benefits and exempt benefits, is that they're non-reportable fringe benefits and reportable fringe benefits. And so I'm saying the exempt benefit is the non-reportable fringe benefit, and that doesn't show up as a income from a government co-contribution total income test perspective. If you've got further questions about that, maybe we can open up the lines later on and we can do it verbally. It might make it a bit easier. So getting back to how much should you salary sacrifice, hopefully that's given you an idea of how much you should salary sacrifice. But it is important that you don't go over your contribution limits. So this financial year, so the 2012-13 financial year, the limit for everybody, regardless of your age, is this $25,000. Next financial year, so the 2013-14 financial year, it goes up to $35,000 for those over 60, and then in the 2014-15 financial year, there should be an index up for those under 50. Those over 50 it should be 35, and so on. So you can see what the rates are. So when you're salary sacrificing, you don't want to go over those contribution limits because you end up paying tax at the highest marginal tax rate. And you've got to make sure that you include your superannuation guarantee contributions in those limits. So you can't just, if you've employers put $5,000 into your super fund as superannuation guarantee contributions, then your limit then ends up being $20,000. So don't go over those contribution limits. Now I had another question from A. Smith, and that was, after-tax contributions made excluded from the $25,000 cap, is it just pre-tax dollars that have the limits? Yeah, you're exactly right. That this limit is the concessional contribution limit. The $25,000 is the concessional contribution limit. You can put more money into your super in what we call non-concessional contributions. And those limits are 6 times the concessional contribution cap. So this financial year, the 2013-14 financial year, the concessional cap for everyone is $25,000. The non-concessional cap is $150,000. And you can bring forward 2 years to put $450,000 into your super fund in any one financial year, as long as you're less than 65 years of age. Yes, they are different caps, and there are two different types of contributions. Now, work-related expenses. It is important to keep a record of all your work-related expenses. There was talk of making a standard deduction for everybody across the board that you could claim. I think it was a $500 deduction, but that was not implemented. So you do need to keep your receipts for all your expenses that you can claim in relation to your work. That rule that you will just get a standard amount that you can claim has not been implemented. Additionally, relating to that, from the 1st of July 2014, work-related education deductions are being limited to $2,000 per annum. So if you've got some self-education expenses that you're going to be incurring and they're likely to be over $2,000, you might want to incur them next financial year and potentially pay for them in June of 2014 so that you can claim the full amount of the deduction, because beyond that, they're going to be limited to $2,000 per annum. So just another handy one for those that are still doing some studies and incurring costs in relation to those studies. This is a Claytons tip from last year, where there was the education tax refund, but it was basically scrapped. So the government scrapped that, and you're no longer needed to keep a record of your receipts, and they replaced it with the SchoolKids bonus, and you didn't need to keep receipts. So the SchoolKids bonus replaced the education tax refund, and there's no need for receipts. If you were receiving the Family Tax Benefit Part A, you would automatically get $410 per annum for a primary age child and $820 for a secondary age child. Now the opposition, the coalition, has announced that they're going to scrap the SchoolKids bonus. So I guess what I'm highlighting here is that if they scrap the SchoolKids bonus and end up going back to the education tax refund, you might need to keep your receipts. So I guess moving forward, make sure you keep your receipts for the next financial year, the 2013-14 financial year, in case the coalition abolishes the SchoolKids bonus and reintroduces the education tax refund, where you need to keep your receipts. But there's no action required, just watch this space. Private health insurance, there's not a lot you can do for this financial year because only a small portion of the year left, and you can't actually go out. If you haven't got private health insurance and your income is, if you're a single, greater than $84,000, if you're a family, over $168,000, if your taxable income's over those amounts and you haven't got private health insurance, then you're going to end up paying a surcharge. And it's 1% for this certain threshold. It goes up to 1.25% for this threshold, and then 1.5% if you're in the higher tax bracket. Now, if you take out private health insurance right now, it's not actually going to save you much in this financial year. But you need to think about potentially doing it for next financial year. So making sure that you actually do it for next financial year, because you might as well get the benefit of the private health insurance rather than just paying out those surcharge amounts. Income protection insurance premiums. Now this is really about incurring expenses earlier in, rather than waiting for them to be paid in the next financial year, and therefore getting the tax deduction from them back earlier. Now, income protection insurance, if you've got it held within your superannuation fund, you can't claim it as a deduction against your salary. But if you've got some complementary or some external to superannuation income protection insurance, then the premium can be deducted against your assessable income to reduce the amount of tax that you do pay. And similarly, other expenses that are relating to your work, if you can pay them before the 30th of June, you're going to get the benefit of the deduction in a couple of months if you submit your tax return, rather than waiting another 15 or so months to get the benefit from them. So that's really about the whole principle of incurring your expenses to reduce, before the 30th of June, to reduce your taxable income. The other one related to that is donating. So if you have received a bonus, or you know that you're going to be incurring some tax and would like to utilise that money to support charitable organisations, then you can make a donation to a tax-deductible organisation. That will then reduce your taxable income and also benefit the organisation that you're donating to. So it's a similar thing to the previous, claiming the income protection insurance, but it's benefiting another organisation. Now, one point here is that I'd just like to emphasise the fact that you don't really want to, let the tax decisions drive everything. Now, I know a lot of churches don't have a tax-deductible fund to give to, but the church still needs the contributions or the giving to keep running. So if you really feel as though you need to give to an organisation, but it doesn't have a tax deduction, I guess I'm just trying to emphasise the fact that don't let the tax drive everything. You might need to be giving to some organisations that aren't tax deductible. Just thought I'd not let the tax, I call it the tax tail wag the giving dog. So the tail wagging the dog rather than the dog wagging the tail. So that's donating. Offsetting capital gains taxes with losses. So if you've sold an asset throughout the financial year and you're going to potentially incur a gain, you could, if you were eligible, make that personal deductible contribution that we talked about earlier on in the session. Or if you've got some other assets that are sitting at a loss, you could potentially sell those or and incur the loss and to offset the gain, so that you don't end up paying tax on the gain. Another way that you could minimise the amount of gain is if you hold assets for longer than 12 months. Because the way a capital gain is calculated is if you've got an asset that you bought, say, for $50,000 and it grew in value to $100,000, then you've made a gain of $50,000. If you haven't maintained that investment for longer than 12 months, you've just bought it in 1 month and then the next month you sold it, the full $50,000 is taxed at your marginal tax rate. So you're going to be paying tax at least on, if you've got no other income, you're going to be paying at least some money at 34%. If you hold the asset for 12 months, then it's discounted by 50%, and so you end up only adding $25,000 to your taxable income. So one way to reduce capital gains is to hold the asset for 12 months at least. The other way to reduce it is to sell some assets that are at loss so that you offset the capital gain. So say, for example, in this case, I've sold this asset, I've held it for longer than 12 months, so I incur the capital gain of $25,000. If I've got a shareholding that's down $25,000, I could sell that, I incur the loss, and then that loss offsets the gain. It actually isn't calculated exactly like that because you don't discount it first. You don't discount the gain first. So I'd really need to incur a loss of $50,000 over here. But basically it's about offsetting your capital gains with your capital losses, or alternatively making a deductible contribution to super to offset your capital gains. Now, one thing to be wary of here is that you can't do what they call wash strategies, and this is where if you've got to incur a capital gain and then you want to sell some shares, for example, to incur a capital loss, you can't just sell the shares on the 30th of June and then buy them back on the 1st of July. That's called a wash sale arrangement, and it's really going to be caught by the tax office as a tax avoidance strategy. But if you're genuinely going to sell the investments at a loss, you can buy them back at a later point in time if you see that they've gone down in value or that you realise that you want to get into them again. But the wash strategies of just selling on the 30th and buying on the 1st is picked up by the ATO, so don't do that. Come on, going backwards. Sorry about that. The other one is prepay interest. This is about incurring expenses earlier. So if you've got a margin loan, so you've borrowed to invest in some shares or other types of investments, or you might have a negatively geared property, or it might even just be a positively geared property, but you want to prepay the interest on it. You can pay 12 months of interest in advance and get the tax deduction earlier. Now, there are pros and cons of this, because what you're doing is you're locking in that loan for the next 12 months. I think most institutions, if you prepay the interest, even if you pay out the loan, you'll still lose that 12 months interest that you've prepaid. So just be careful about that. You need to know that you're going to be holding the investment for 12 months. You're fixing in the interest rate. If interest rates go down a couple of notches, like many economists are predicting that they will, then you're locking in a particular rate of interest. And the other thing you start to do is that you start to need to do that each financial year. If your income levels stay the same or continue to go up, to make sure that you don't get a big tax bill the next following year, you need to almost prepay again that financial year again. Otherwise, you're going to have a year where there's no interest claimed for that particular financial year, and then you'll end up paying a higher amount of tax. So just be aware of those concerns there. Another one that isn't that well known but might be useful for people who haven't owned or haven't lived in a property that they've owned. So you could have an investment property but not ever actually lived in it. You may be eligible for the first home savers account. I've run into some pastors who are eligible for this particular account because they've lived in a manse their whole life, or a church provider property. They may have actually owned an investment property but never actually lived in it. They are often eligible for what we call this first home savers account. Or you might be, in other scenarios, you might be wanting to assist your children or grandchildren save for their first home. Now, it's not that commonly known because the financial institutions that operate it don't make a lot of money from it. And there's also a requirement that you need to put in $1,000 over 4 financial years that has prevented a lot of people, they feel as though those restrictions are too much, and so they haven't actually taken advantage of the account. But for somebody like a minister who's not lived in a home that they've owned, they could use it to boost their super as well, because you can only use this account for 2 purposes. One is to buy your first home that you're going to live in, and the second purpose you can use it for is to direct it to your superannuation. So it could be used as either a way to buy your first home or to boost your superannuation. How it works is that you can put up to $12,000 into the account each year, and so $12,000 each year, and the government will match it with a 17% co-contribution on the $6,000, the first $6,000 of it, which means 17% of $6,000 is $1,000. So generally, I don't say put $12,000 into the account, but put $6,000 into it, get the $1,000, $1,020 co-contribution, and then you can start to build your deposit for a home. You can a couple and a spouse can have an account each, so you can put $6,000 each into an account and get a $2,040 co-contribution, and then you get interest on it as well. So you add your 17% plus another 4% interest, you're getting over 20% return on that investment. So it's a really effective way to save. This is the key that people need. Put a lot of people off, because you need to contribute $1,000 over 4 financial years to be eligible for it. But if you look at this particular scenario, I've done it again, gone to the next slide. If you look at this particular scenario, you can actually access the account within about 2 years. Because if we put $6,000, so we're saying here in this example, we're putting $6,000 each, this is a couple putting $6,000 each into their own accounts this month, and they'll get a government co-contribution of $2,040. Over the year, they'll get some interest, and so their total balance after a year would be about $14,500. Next year, June 2014, I'll do the same, another $6,000 each. Another $2,000, they'll get a bit more interest. Now they're up to nearly $30,000 in saving. The following year, they'll do the same thing. And in July of 2015, they do the same thing. They've got over $8,000 in co-contributions. They've got some interest. And within 2 years, it's only a bit over a month over 2 years, they've turned their $48,000 here into $58,000. So you can see, however, in 2 years it can be a really beneficial thing, and that might be, as I mentioned earlier, it might be your first home saver, or might be somebody who's never owned investment properties but never lived in those properties. David asked the question, I've heard that once I turn 55 I can start to draw on my super. My wife and I are paying off our home loan. Do you think that this is a good idea? Generally, yes. Generally, we like to pay off our mortgage as a priority because it's not deductible debt. It's great as you approach retirement to have paid down all your debt, and it reduces the outgoings and the associated stress with the pressure of debt. So generally, yes. And once you've reached preservation age, which is currently 55 for people, it's moving up to 60 depending on your date of birth, but it's currently 55. You can effectively roll over your superannuation to pension phase, and it saves tax within the fund. So when your money's in the accumulation phase, it's taxed. The earnings on the fund are taxed at 15%, and when it's in the pension phase, there's no tax payable on the earnings within the fund. So you get the benefit of that, and then you can draw up to 10% of the balance of the fund if you haven't satisfied a condition of release. That means you haven't stopped working. You can still draw up to 10% of the balance of the fund. So if your fund is worth $100,000, the balance of it, then you can draw $10,000 from that fund each year, and you could potentially put that down, pay that off against your mortgage. Now you need to be a bit careful here, because whilst you're under 60 years of age, generally what we do is you draw the minimum amount from your pension, which is, if you're between 55 and 65, next year it's going to be 4% of the balance. And the reason we say draw the minimum amount is because you can pay some tax on the drawings depending on what your taxable income is. And so the way that works is if you're drawing, say, $10,000 from the fund, you end up, that $10,000 ends up adding to your taxable income, and then you get a 15% rebate. So if your tax rate is 34%, if you're paying tax at 34%, then you might end up paying tax on the drawings when you're under 60 of that less your 15% rebate. So you end up paying tax around 19% on that money, depending on what the components are. So just be a bit wary of that when you're under 60 years of age. Once you hit 60, it comes to you totally tax-free, so then you can draw down your 10%, pay down your mortgage as quickly as you like. So yeah, hopefully that gives you some indication of how to structure that, David. I just got a couple of other questions. These are two similar questions from Stan and from Elaine, and it was about when the change in the rule when you turn 70 years of age. Previously, your employer didn't need to pay the superannuation guarantee contributions. There was no need for them to be paid. Now, the rule has been changed as of the 1st of July. So from the 1st of July, Superannuation guarantee has no age limit. The age limit has been removed altogether. So employers generally need to pay superannuation guarantee contributions. And as of the 1st of July, superannuation guarantee contributions are going to 9.2, if I can get the point, 9.25%, up from 9%. So if you're an employer, you need to make sure you're paying that 9.25% and working out whether that's coming from your side of the equation or your employee side of the equation. If you're an employee, you need to make sure that you're getting a 9.25% and understanding whether it's coming from your current package or it's being added to by your employer. I've done it again. A couple other questions from Don. One was about budgeting tools and practices. What do you find the best results for users and reader usability and actually running the budget? It is really a personal thing, how you run your budget. Some people like to use the paper-based budget where they draw up a whole chart. They put across the top all their spending categories, how much they're going to spend for that month, and down the left-hand side they put the 30 days of the month, and they record all their spending each day. And once they've gone over their budget for that month, they don't spend anything else in that particular column. So there's paper-based. There's the spreadsheet type thing, so your Excel type approach, where you can record it electronically. There's a lot of packages these days. I don't know them all. So you can use the QuickBooks and the MyOb, and there's lots of little packages that you can use. And then there are these other programs like Crown Financial Ministries used to have one called, I think it was Envelopes. Envelopes, I think it was spelt. And it would actually download your transactions from your bank account. You would set up the budget prior to that, and you would basically have this whole thing happening electronically, downloaded, and you just allocate your spending, and then it memorizes what those items were and continues to do that into the future. So it really gets down to your own personal preferences. One default, I often run into people who are just not budgeting at all, and so one default mechanism of budgeting that works really well is that if you've got your personal bank account, so it might be a spouse's, and they have their incomes coming into that account, so two separate incomes from spouse 1 and spouse 2, and what we do then is that if they're structuring it like this, we hive off straight away our giving, so we do our giving over here. We put aside any money that we need for taxes, and then we put aside some money for saving, and whether that be paying off a debt or saving. And then there's debt repayments, and then so we've allocated all these most important things, the big rocks first, and then they can spend the rest for the month. So whenever the pay comes in, we take these out straight away, and then they can spend whatever's left. And if they run out of funds for the month, then they just need to get creative about how they operate for the remainder of the month. The key to this is that you can't use credit cards. You need to use debit cards. So that's just another idea for you, Don. Hopefully that helps. And I've done it yet again. Just quickly check. I've got a question popping up. Yeah, thanks, Keith. He said 9.25% superannuation guarantee increases from the 1st of July 2013. I might have said something different. Yeah, it is from the 1st of July 2013. Yeah, that's exactly right, Keith. Thank you. So the other question we had was from Sue, and she asked, what are the key factors to determine exactly when to begin a transition to retirement which affect super contributions and tax planning? Well, the first one is your preservation age. Now, I've not got the chart for that here. I'm wondering if I can pull it up from another presentation. If if you're born before 1960, your preservation age is 55. If you're born after that, then it starts to increase to 60 years of age. So your first thing that you need to factor in here is your preservation age, because it's preservation age. That's the age at which you can access your super, and that's when you can move from accumulation phase to pension phase. So that's the first thing to understand. The other key to that is that if you reach your preservation age and you've got a small amount in your superannuation fund, there's not that much value in moving to pension phase. But if you've got $80,000 to $100,000, then generally it's worthwhile moving to pension phase because you're going to get the tax savings within the fund. That's the key. Your preservation age is the key, and then how you structure it, to what degree you structure it, and how much you salary sacrifice, for example, depends on your level of income, how much cash flow that you have, and I guess whether you've got a mortgage and all that sort of thing. So, and whether you're over 60. So you might have reached your preservation age, as I mentioned earlier with another question. You might have reached your preservation age and be under 60, and the money that you draw from your super at that point in time is still a little bit taxable. Whereas once you've reached your 60 years of age, then it becomes totally tax-free, and you can start to be a bit more aggressive with what you're drawing from your super to either pay down debt or salary sacrifice more. So hopefully that helps you, Sue. Mel just asked a question. My husband retired during this financial year and turned 65 in October 2013. How long can he keep putting in non-concessional contribution payments? Good question. He can put in non-concessional contribution payments until he turns 65. If once somebody turns 65, and this is an important one for you, Meryl, is if you've got money outside of super, whether it's an investment property or some other asset that is outside of super, there's a unique opportunity for someone who is under 65 to still utilise the bring forward rule. But, so you can still bring forward the 2 other years or $450,000 in non-concessional contributions if he's under 65 years of age. You just need to check as well the work test. So you could still put non-concessional contributions into his super fund after 65 years of age, but you then need to satisfy the work test, which is 40 hours within 30 days within that financial year, and there's no bring forward rule. So it's a key time frame in terms of considering strategies before turning 65 years of age. Thanks for the question, Meryl. Just continue on through the questions here. Actually, that's all I have for the questions at the moment. If you do need further resources, and I guess you can call the Christian Super Help Desk on 1300 360 907. There's the Christian Super website that they've just upgraded to a new design. There are other webinars that we'll have going throughout the year. So at the end of July, for those people that ask those questions about transition to retirement, then in July, towards the end of July, we'll do another webinar specifically about that, transitioning to retirement, and we go into it into a fair bit of detail. So look out for that at this particular site. I think Christian Super will probably send out an email as well. There is a 2013 budget webinar recording that is available through here, and there are the slides available to it as well. And it goes into the super rules in a little bit more detail, so you can check that out. If you have other questions, you can call me on 1300 275 428 or go to the website. But I'm just going to open the lines up now. We've got another 8 minutes before 9:30, and I can go beyond that. I'll keep asking your questions until there are no further questions. So either put your hand up and I'll open the line for you to ask your question verbally, or if you continue to put your questions in the chat section on the right-hand side, I'll just continue to answer those questions over time. Keith just said, could I speak to you later on? Yes, I'll give you a bell, certainly. And that's the only other question I have at the moment. So do fire through questions if you do have them. Or alternatively, put up your hand, and I'll open your line to ask an audio question. It's just a few other tips whilst I'm waiting for any further questions. Another one is income splitting. I'm not sure if you're aware of how that works. Often I come across members of a spouse who hold their investment accounts, whether that be term deposits or a high interest at call account. They often hold those accounts jointly because that's just what they've always done. If you have one spouse that's earning less than $20,500 and paying no tax at all, and you've got another spouse who's paying or earning income over $20,000 and paying tax at either 20.5% or 34% or more, then it makes sense to hold those interest-bearing accounts in the lower income earner's name, and then the tax associated with that can be then totally tax-free rather than paying half of that money out in tax at the higher income earner's tax rate. Peter just said no questions, but thanks for the information. My pleasure, Peter. Appreciate you joining us. And Keith just saying thank you. My pleasure, Keith. We'll speak to you tomorrow. So let me know if you have any other questions, whether they be superannuation or more tax driven. Yeah, another strategy that's just looking at some other strategies that I've got here. Another strategy that can be useful is deferring income. And income can be like selling an asset and then incurring a capital gain. If that's a scenario that you are in and you're wanting to sell either investment property or some shares, and it might be to either pay down some debt or it might be to get the money into the tax concessional superannuation environment, a good way to structure that is in a year of low income. So it might be in the year that you retire. So a way of managing that is you might work into July of the financial year. So you've just got 1 month of income. That could help you satisfy the work test if you need to get money into super. And then you sell the assets. So you've got a low level of income at that point in time. And then you could also potentially make contributions to super and claim a deduction as well. So just managing those sort of asset sales can be a beneficial way of doing it. But I think that's nearly covered off all that I need to go through at this stage. So if there's no other questions, I might just leave it at that. Oh, here we go. I was just asked the question, if you have money inside super and outside super, is tax concessions the main reason for adding money to your super fund, aged between 60 and 65? Yeah, a reason for adding money to your superannuation is a couple of fold. One is that you're moving money into the concessionally taxed environment, and Secondly, it can have some Centrelink benefits as well at a later point in time. Actually, there's a change in the rules that was announced in the federal budget, so in May, where they're going to start deeming. That means assuming a certain level of return on account-based pensions. So an account-based pension is when you move your superannuation money from accumulation phase to pension phase and start drawing from it. That's an account-based pension. Currently, Centrelink don't deem it. They don't assume that there's any form of earnings on it. From the 1st of January 2015, they're going to start deeming them. So there's going to be some advantage in moving to the pension phase of superannuation before the 1st of January 2015. So that's a reason for getting money inside of super that's potentially outside of super, because if you don't, and you don't do it before that date, it can actually mean that you get less age pension over the longer term. And if that's a window of opportunity before you can no longer put any further money into your super fund, it's well worth considering whether that's the appropriate thing to do. Michael's just saying many thanks for your help. Appreciate that. Good to see there's a Victorian online. David's got no further questions. I answered yours. Thank you, David. Appreciate that. Scott says, have a good night. See you too, Scott. Appreciate you being online. Shirley says, thanks for the great webinar. Jim says, hi, Gavin, I have a question, but my hand signal is not working. Oh, thanks. I'll open your line. It's nice to at least do one verbal question. Now, let me find where your hand is. And nice to have you on board, Jim. Yeah, I haven't been able to open your line for a question for a while.
It's okay.
Now I've opened up so we can hear you now, Jim. Go for it.
All right, thanks, Gavin. This question relates to concessional contributions through salary sacrifice. And the question is, at what point is the concessional contribution taxed? I presume this is at 15% as it goes in, but is this taxed at the end of the year or as it goes into the account?
Yeah, it's a good question. Funds have been, I guess, operate differently depending on what their particular structures are. But the government recently announced that funds are going to pay tax on a monthly basis. So the government's trying to get a bit more revenue through and get it through more quickly. And so they're requiring funds to actually pay that tax on a monthly basis. So it is going to be deducted on a monthly basis, at least moving forward. It may have been at a longer duration, say quarterly previously, but now they're going to be deducted on a monthly basis, I understand. I'm not sure exactly what date that starts. I'm not sure whether it's the 1st of July or whether it's the 1st of 2013 or 1st of July 2014.
So it's quite possible it's quite possible in the current year the tax won't be deducted until the end of the year?
Yeah, you're getting into an area that's not, I'm not 100% on, Jim, but there is that potential, particularly because what can happen is that you can actually claim a deduction on your funds after the end of the financial year. So the personal deductible contributions that I talked about before, I could make the contribution on the 30th of June, for example, but the tax won't be deducted on that contribution until the next financial year. Yeah, and I can actually specify the amount that I want to claim later on using a special form. So I'm doing that with a client at the moment where we've made a contribution of $16,000 because we know that there's going to be some tax incurred. We're not 100% sure how much tax there will be payable and what the optimal amount is to claim a deduction for. So we've put $16,000 in. But once we've worked out with the accountant exactly how much tax is payable and what the optimal deduction is, we're going to write to the fund and say, we want to claim $15,000 or $14,000 of this contribution as a deduction. So that can actually happen after the end of the financial year.
Okay, well, I think that probably answers the question then. Thanks, Gavin.
My pleasure. Thanks for being on board again, Jim. Nice to talk to you again.
Okay, righto. I'll sign off now then. Thanks very much.
Okay. Good night.
Night.
Okay, I think I've got a couple of other questions. I'll just keep going through. Michael's asked, is there a maximum amount of money that you are allowed to deposit into your first home buyer's account? Yeah, it's $12,000 a year, but it's the co-contribution amount, the 17%, is only on the first six at the moment. It gets indexed up, but what started at $5,000 when the account was initially started, and it's slowly been indexed up to $6,000. So yeah, you can put in it's $12,000 per annum, but then there's a figure of around $85,000 or $90,000 that your account can get to, and then you can't make further contributions to it. So there's two contribution limits. There's the annual limit of $12,000 per annum currently, and then there's the total limit of, I think it's around $90,000 at the moment. Once your account hits that figure, then you can't contribute more to it. I hope that answers your question, Michael. Meryl says, thank you very much. That's helpful. Pleasure. Thanks for being online, Meryl. Kim says, thanks for advice tonight. Pleasure. Rachel asks, can you partly prepay interest on a margin loan? We have a margin loan which we have always prepaid but are looking at getting rid of shortly, so want to minimise tax. Well, yeah, the risk of that, Rachel, as I understand it, but check with your margin lender, is that if you partially prepay it, as I understand it, you're partially prepaying 12 months. So if you're going to get rid of it in 6 months' time, you've kind of prepaid 12 months of interest, and I don't know whether you can allocate. I don't know whether you can pay half the year's interest for the 6-month period, but just ask your margin lender. It'd be well worthwhile considering. But if you are going to, scale it back, I would potentially, not worry about it, unless you've got a bit of a lumpy, as in a large, unexpected tax payable this financial year. I hope that answers your question. But yeah, really go back to your lender and check what you're prepaying. Are you prepaying half of the interest for 12 months, or are you paying half of the interest for 6 months? So yeah, just check what the rule is and what you're locked into. Peter says, I need to go now. Bye. God bless. Thanks, Peter. Appreciate you being online. And Michael, I have answered your question. Thanks for letting me know. I appreciate that. Now, there are no other questions just before I sign off. Actually, there's a hand up, so I'll just quickly check whether someone wanted to ask a question audibly. That's Michael. Michael J. If you wanted to ask a question, I can open your line. I'll do that now and see if you've got a question. G'day, Michael. Did you have a question that you wanted to ask via the mic, or did you just have your hand?
No, it's okay. I just was wanting to say thank you. I've been listening in quietly and getting some advice, so it's been a blessing.
Oh, my pleasure. Thanks very much for being online, and thanks for the feedback. Appreciate it.
Good on you.
That's great. And I think that's about all. So really thanks for your involvement tonight. I really appreciate you coming online in the evening when there's many other things to do. But thanks again for being with us, and hopefully it's been of benefit to you. God bless and good night.